Hello, everybody. I am going to briefly explain how to do the brief exercise on chapter 3, number 11. This is for lesson 4. So, when I like to think of, first off, is to see what they want. So that's up here from the ledger balances below, prepare a trial balance. And it says all account balances are normal, and I highlighted that normal in red because it is very important to know if an account has a normal balance in the debit side or the credit side. So to begin with, and I already have the trial balance set up. It says June 30th, 2017, and that is correct because it's a moment in time. It doesn't explain a whole month or a whole year like the income statement. Okay, so to start off, it took me, I'm about in my senior year in the accounting program, but it took me quite a while. I struggled through trying to memorize the normal balances of accounts, but eventually I kind of found a shortcut. If you just try to think about what happens to the cash in an account, it kind of helps you realize whether it'll have a normal debit side or a normal credit side. So let's just plug in cash here. We all should know that cash should have a normal debit amount, as long as we're not in the hole. So we put in our cash right there, 5720. Then we'll just go through in order here. The accounts payable, if we think about what happens with cash, to have a normal balance is when it's increasing. So when it's increasing, you're not going to touch cash. You're not going to touch cash until you actually pay off your debts. So in accounts payable, when you pay off your debt, it is going to decrease the accounts payable. And it's going to decrease your cash. So what happens is you'll have to credit cash, which means you'll be debiting accounts payable every time you pay off your debts. So when you're increasing it, that means it's on the credit side. I'm going to put that there. We already did cash. Common stock. What happens when we increase common stock? We're also going to increase our cash. So if we're going to debit cash when we ask for common stock because we're getting investors to get money into our company, if you debit cash, you're going to have to credit your common stock to increase it. So that means it has a normal credit balance. Hope this is making sense. Whenever you do a transaction, you have to have one on the debit side, one on the credit side, or multiple on each side, depending on how many you got going. So common stock is a credit balance. Dividends. Dividends is what we call a contra asset account. So when you increase dividends, you're going to have to credit cash because you're giving some of the common stock back, and you're going to be debiting your dividends. Equipment, it's an asset account. You can kind of remember it like that. All asset accounts should have a normal debit amount, but when you think about the cash, you're going to be crediting cash when you buy equipment, so you're going to be debiting the equipment. Service revenue. What is going to happen with cash on the service revenue? When you get the revenue, you're going to either debit, so you're going to receive cash or an accounts receivable. So service revenue must have a credit balance. That is normal. So we're going to put that in the credit side. Now accounts receivable, we just kind of talked about that. If you're going to be getting revenue, it is going to be credited. And so accounts receivable must be debited. Because when you get cash on that accounts receivable, you're going to have to debit cash and credit your accounts receivable when you receive the cash that you are owed on those accounts receivable. Salaries and wages expense. Let's think about what happens with cash on those. So if we are paying an expense, we're going to be crediting cash and debiting our expense column. That's true on all expenses. So if it has expense in the name, it's pretty easy. Same with renting. Any expense, you're going to be losing out on some cash, and you're going to be debiting some expenses. So it takes a long time because we're used to thinking, no, debit means positive cash amount and credit means a negative cash amount. That's not always true. You just kind of have to think for a second on what's happening with the cash flow. Think about if the cash is going to be incoming or it's going to be outgoing. And if it doesn't have to do with cash, if it's a receivable account or accounts payable, then you kind of have to think ahead in the future of what's going to happen when that account gets realized or when that debt or is come due when they give you the cash. Think about that way. So if you just try to trace the cash, you'll be able to find out which accounts have a normal debit balance and a normal credit balance. And you see here, in the trial balance, those should equal. So we're good there. And just to show you guys that I did do the problem on Wiley Plus. Let's see if it's showing it. Sometimes I have to stop it. Yeah, it looks like I'm going to have to stop the screen share and reshare it. Okay. Shows here, answer's correct. I copied it over on Excel. So it's a little different formatting, but yeah, your balance is there. Your count's there. Shows down here. Same thing, just like what we did on the other side. So I hope that kind of helps you guys understand a little bit better on how to figure out whether an account has a normal debit balance or a normal credit balance.